Is the future of crypto quietly shifting in a way that could undermine everything it was built to stand for? In today's video, we're uncovering the most chilling trend of 2025, a powerful force that analysts say could reshape the crypto landscape, and not for the better. We'll break down exactly what's happening behind the scenes, why it has the smartest voices in finance concerned, and how you can position yourself wisely as the market changes. Stick around, because the risks aren't obvious at first glance, but missing them could be costly. Let's get started. 1. Surface optimism. Why 2025 looked so bright at first? On the surface, 2025 looked like the golden age for crypto. Bitcoin ETFs were launched and flooded with institutional money. Ethereum's upgrades unlocked faster transactions and lower fees. Altcoins rode the wave of mainstream adoption as traditional finance started offering crypto services. Major headlines celebrated crypto's arrival into the global financial system. New investors felt more confident than ever. It seemed like mass acceptance was finally here. But underneath the euphoria, certain foundational shifts started happening. Shifts that pointed toward a creeping centralization and structural weaknesses. The early signs were easy to miss unless you were looking closely. 2. The disturbing shift. Centralization at the core. One of the most worrying changes in 2025 is the centralization creeping into crypto's core infrastructure. A handful of giant players now dominate crypto exchanges, custody solutions, and validator operations. What was once a decentralized playground of innovation is increasingly controlled by a few megacorporations. These entities have the power to freeze assets, influence consensus mechanisms, and dictate liquidity flows. While they've made crypto safer for newcomers, they've also reintroduced the same centralized risks that crypto was created to eliminate. Analysts warn that unless decentralization remains a real priority, crypto could evolve into little more than FinTech 2.0. 3. Staking monopoly. A new threat to blockchain security. Ethereum's post-Pectra landscape made staking more accessible, but it also allowed giant institutions to scoop up enormous amounts of validator power. A growing number of staking pools are now controlled by a few massive players, concentrating validation rights. This is dangerous because it weakens the network's security model and could, in theory, lead to coordinated attacks or censorship of transactions. True blockchain resilience depends on distributed control. If staking power continues to consolidate into a few hands, Ethereum and other networks could face systemic vulnerabilities that undermine their credibility as decentralized financial backbones. 4. DeFi isn't so decentralized anymore. Decentralized finance, DeFi, was once the ultimate rebellion against traditional banking. In 2025, though, many DeFi platforms are starting to mirror the systems they set out to disrupt. Major protocols now rely on centralized governance structures where a few whales, often venture capital firms or institutional investors, control proposals and upgrades. Behind the scenes, decisions about interest rates, collateral standards, and reward systems are being shaped by backroom deals. This consolidation means users have less say, more exposure to governance risks, and greater dependency on a few power brokers, which runs counter to DeFi's founding principles. 5. Custodial wallets surge. Crypto's core principle eroded. Self-custody, the ability to truly own your assets, was once crypto's non-negotiable core. But in 2025, the use of custodial wallets is exploding again. Big platforms offer easy staking, yield generation, and trading features in exchange for holding your private keys. It's frictionless, it's convenient, but it's a dangerous trade-off. By ceding control to third parties, users are reintroducing counterparty risk into the system. Hacks, insolvencies, and policy changes could once again separate investors from their assets overnight. This shift signals that while adoption is growing, understanding and respecting crypto's core ethos is sadly slipping away. 6. Regulatory arbitrage. Risk moves offshore again. As governments tighten crypto regulations in major economies, projects seeking speed and flexibility are relocating offshore, often to jurisdictions with lighter oversight. This regulatory arbitrage mirrors what happened during earlier crypto booms, While it sparks innovation, it also invites risky behavior and shady practices. Offshore projects often lack transparency, exposing investors to fraud, market manipulation, and sudden legal clampdowns. Analysts warn that while regulations are frustrating, operating in lawless environments makes the entire ecosystem more fragile. Without balanced global regulatory frameworks, crypto risks fragmenting into trusted and untrusted zones, eroding its long-term credibility. 7. Flash crashes and AI-driven volatility. Artificial intelligence trading algorithms now dominate crypto markets, creating a new layer of volatility that even seasoned traders struggle to manage. These AI bots react to data in milliseconds, triggering chain reactions that cause flash crashes or unnatural price spikes. Liquidity gaps can be exploited instantly, and traditional stop-loss strategies often fail. It's no longer just about market fundamentals. It's about machine learning models battling for microsecond advantages. For regular investors, this means sudden, extreme price swings with little warning. Analysts are concerned that without safeguards, AI-driven volatility could make crypto markets even more unpredictable and dangerous. 8. Fragile liquidity under the surface. While daily trading volumes might look healthy on the surface, real liquidity in crypto markets is more fragile than it appears. Many assets, even in the top 100, suffer from shallow order books. This means that even moderately large trades can cause outsized price movements. Bots dominate much of the displayed volume, masking the reality that human fundamental-driven liquidity is thin. During market stress, bid-ask spreads widen dramatically, and prices can collapse faster than anticipated. Analysts worry that in the next true panic event, liquidity could evaporate even faster than during previous crashes, amplifying losses across the ecosystem. 9. Analyst warnings. Red flags you shouldn't ignore. Top market analysts are sounding alarms, pointing to the worrying signs we've discussed. They highlight the risks of centralized staking, fragile DeFi governance, thin liquidity, and unchecked AI trading as systemic vulnerabilities that could trigger the next major crypto collapse. Their message is clear. Surface-level optimism shouldn't blind investors to the deep cracks forming underneath. Smart money is already adjusting strategies, moving to self-custody, diversifying into real-world assets, and reducing exposure to centralized platforms. Ignoring these warnings isn't just risky. It's the kind of mistake that could erase years of gains in a single cycle. 10. Smart moves. How investors are adjusting to the new reality. The investors who will survive and thrive in this new environment are already adapting. They're prioritizing self-custody, using cold storage solutions to truly own their assets. They're diversifying portfolios to include assets outside pure crypto exposure, like tokenized real estate and regulated digital bonds. They're focusing on projects with strong decentralization and governance transparency. And they're respecting the risks of thin liquidity and AI-driven volatility by setting smarter stop losses and keeping higher cash reserves. The key lesson: hope for the best but prepare for the worst. Staying flexible, cautious, and strategic will be essential for navigating 2025's crypto landscape. Crypto's biggest risk today isn't just another price crash. It's losing the spirit of decentralization that made it powerful in the first place. Thanks for hanging out with me here at Nexus Dividends. If you found this breakdown eye-opening, smash that like button, comment your thoughts on the biggest threat you see, and don't forget to subscribe for more sharp, real-world investing and crypto insights. Stay smart, stay critical, and I'll catch you in the next one.